Hello, everybody. In this time, we are talking about an interest rate. The interest rate is the percentage of interest relative to the principal. It is either what lenders charge borrowers or what is earned from deposit accounts. The interest rate on a loan is typically not on an annual basis and is expressed as an annual percentage rate or APR. An interest rate can also apply to a savings account or a certificate of deposit or CD. In this case, a bank or credit union pays a percentage of the funds deposited to the account holder. Annual percentage yield or APY refers to the interest earned on these deposit accounts. And then, how are interest rates determined? Interest rates are determined based on a variety of factors. The first factors, inflation and the overall state of the markets and economies. Inflation and the economy impact interest rate in a few ways. In Indonesia, Bank of Indonesia may raise or lower interest rates to attempt to control inflation and other market forces to keep the economy healthy. And then second, the type of investment. The same is true with instruments. Typically, the lower the risk, the lower the potential interest rates you can earn. For example, a certificate of deposit investment is one of the most low risk options, but you typically won't earn a huge rate of return. However, if you take a chance on an up and coming company, you could see a return if the company takes off. On the other hand, if the company doesn't do well, you may lose money. And then the third, your personal credit. Your credit history impacts the interest rates banks are willing to offer when you apply for credit. A better credit score typically allows you to get better interest rates because the lender sees you as a lower risk than someone with a poor credit score. Lenders may charge a higher interest rate so they get more money upfront when someone doesn't have a good credit history. This helps them mitigate losses should the person fail to pay the debt as agreed. And then, how interest rates work. The bank applies the interest rate to the total unpaid portion of your loan or credit card balance, and you must pay at least and the interest in each compounding period. If not, your outstanding debt will increase even though you are making repayments. Although interest rates are very competitive, they aren't the same. A bank will charge higher interest rates if it thinks there's a lower chance the debt will get repaid. For that reason, banks will tend to assign a higher interest rate to revolving loans such as credit cards, as these types of loans are more expensive to manage. Banks also charge higher rates to people they consider risky. The higher your credit score, the lower the interest rate you will have to pay. And then we move to types of interest rates. The first type, fixed interest rate. This rate stays the same for the entire loan period, making it easier to predict repayment amounts. And then the second, variable interest rate. This rate changes based on a benchmark rate, which can cause payment amounts to vary over time. And third, annual percentage rate, or APR. The APR includes the interest rate plus any fees related to the loan, giving a clear picture of the total borrowing cost for a year. And then, what is the difference between interest rate and interest? At its most basic, the best interest definition is the fee that you pay for borrowing money. Interest rates are simply a way of measuring how much interest you'll be paying on a loan. So, if you have a mortgage with an interest rate of 5%, you'll be paying 5% interest on the amount you've borrowed. Conversely, if you have a savings account with an interest rate of 2%, you'll be earning 2% interest on the money you have saved. It's important to remember that interest rates can change over time, which means that the amount of interest you're paying or earning can also change. So, whether you're looking to take out a mortgage, saving for the future, or take out any kind of loan, it is important to understand what an interest rate is and how it can affect your finances. By understanding the basics of interest rates, you'll be in a much better position to make informed decisions about your money. And then we move to impact of high versus low interest rates. High interest rates make loans more expensive. When interest rates are high, fewer people and businesses can afford to borrow. That lowers the amount of credit available to fund purchases, slowing consumer demand. And at the same time, it encourages more people to save because they receive more on their savings rate. High interest rates also reduce the capital available to expand businesses, strangling supply, and this reduction in liquidity slows the economy. Low interest rates have the appropriate and opposite effect on the economy. Low mortgage rates have the same effect as lower housing prices, stimulating demand for real estate. Savings rates fall when savers find they get less interest on their deposits. They might decide to spend more. They might also put their money into slightly riskier but more profitable investments, which drives up stock prices. If low interest rates provide so many benefits, why wouldn't they be kept low all the time? For the most part, the Indonesian government and Bank of Indonesia prefer low interest rates. But low interest rates can cause inflation. If there is too much liquidity, then the demand outstrips supply and prices rise. That's just one of the causes of the inflation. I think it is enough for this session. Thanks for watching, and don't forget give this channel with your like, comment, subscribe and share. Thank you.